Hi, my name is Francesco Filia. I'm a CEO and CIO of Fasanara Capital. I'm here to talk to you for a few minutes about deflation in Europe, which we believe it's a condition of the European markets which is likely to stay with us for the foreseeable futures for the next few years, and is going to lead into an amazing trading opportunity. In the next few minutes, I will discuss the fabric of deflation in Europe and its market consequences. I will draw a comparison between Europe today and Japan in the early 90s. I will describe the consequences for the ECB, the implication for the ECB, and what the ECB is likely to do from here on. And then I will discuss the timing and the format of a few trading strategies that are intended to bank on the opportunity. In terms of the end result of the market framework that we see coming in the next few years, we believe that three things will happen. Rates will reach new lows. We think that especially at the far end of the Bund curve, we'll be able to see rates lower than their equivalents in Japan, so the 10 years moving closer to 50 basis points, the 30 year moving closer to 1.5%. And then we will see spreads compressing across peripheral European markets and their spread against Europe. We will see, for example, BTPs at a spread of lower than 100 basis points versus Germany, from 140 basis points now, and against France and French OATs at a spread of lower than 60 basis points from 110 basis points now. Finally, we will see risk primary imploding and interest rate curve flattening. We expect curve spreads across the curve to tighten from current levels as a reflection of a multi-year deflationary process taking its grip on the markets. In terms of the comparison with the Japan, as I said, we believe Europe looks like Japan in the early 90s. There are certain connotations that are unmistakable and that they are shared between Europe today and Japan back then. There is a high level of indebtedness which is able to drive away resources from productive investments into sterile debt payments. There is an overvalued currency. At the time the yen was overvalued, and it kept appreciating as a result of the deflationary conditions of Japan slowly materializing, and the same can be said for the Europe. We estimate that peripheral European countries are 20 to 30% expensive in terms of overvalued currencies vis-a-vis the Deutsche Mark, and they are 30 to 40% overvalued against much of the rest of the world. So we believe that the European markets on Southern Europe are experiencing a currency crisis, and the aftermath of a currency over appreciations, as if they had borrowed in foreign currencies, and in this case into Deutsche Mark. Another connotation which they share, Europe and Japan, it's an inactive central bank, or a central bank which decides to become active too late, and possibly also does too little too late. And then we see more structural connotations like a falling working population and a falling productivity rates. Today in Europe we have a level of the euro which despite the recent weakening against the dollar, is still far too strong against the GDP prospects, the inflation prospects, and the productivity trends of European markets against the US and the UK and so many other countries around the world. And then we see also that there is a misleading current account surplus for 200 billion, which has only managed to make the euro stronger in the last few years, helped by a shrinking balance sheet for the central bank, the ECB, by over 1 trillion euros in the last few years, as a consequence of the leverage flows by the banking system and by the private sector, and also LTRO repayments. And one problem with the crisis management resolution of European policymakers has been one of diagnosis. The problem has been thought to be the lack of structural reforms, whereas the problem was one of deficient structural demand, and as a consequence of that, the policy making that has been put in place was possibly not the right one. It was one intended to drive internal devaluation to peripheral European countries, which is itself a form of deflation. So the ECB balance sheet has been allowed to shrink for almost 2 years now. The euro has been strengthening as a consequence of that against most other currencies around the world. The austerity measures, on top of all of that, have been imposed on peripheral European countries in order to shrink fiscal deficits, and that has helped in a way the strengthening of the currency and the deflationary trends across Europe. And then in addition to that, which is something specific to Europe, you had all across globally some forces leading to deflationary status. We have the so-called Amazon effect, where robotics and technological advances have been shredding job and also depressing input prices, but you also had lower energy prices as a consequence of the shale gas and shale oil revolutions and the commodity, the end to the commodity super cycle. Then you had weakening potential growth, which is kind of recognized the world over. And then finally you had zero interest rate policies in the US and a weak US currency. You had a weak yen currency, yen devaluation, which has been exporting deflation. You had the China soft landing / hard landing. So a number of forces which have led into lower inflation rates globally, which have been adding on to the more European specifics problem. The problem with deflation is very clear. Deflation is a problem especially to countries with a high level of indebtedness, because it makes their real indebtedness higher and higher as inflation rates gets closer to zero and then it goes into negative territory. Zero inflation is like a death penalty to a debt-laden country. And the result of this is that for countries like Italy and Spain, for example, that their debt ratios have been increasing. Italy is expected to be like into 140% debt on GDP by the end of this year already, due to the disinflation and the GDP contraction. And at the same time, zero inflation rates, close to negative, are going to be making real rates too high in Italy against France and Germany. Real rates in Italy are 200 basis points above France, 250 basis points above Germany. So even if the absolute level of the yield is not that high, it's an historical low, still the real rates are very much very high and unsustainable against a contracted economy, as it is the case in Italy. It has, inflation rates, they make the debt ratios go worse, even if the GDP stops contracting and stays stable. By the nature of things, if it's been estimated that if Italy wanted to keep their debt to GDP ratios unchanged, so keep them from deteriorating further, would have to have a primary surplus of 8%, which is an astonishing number, is one which is impossible to achieve. And if it was tried by Italy to achieve that, it would lead into more internal devaluation, more austerity, more contractory policies, so it would be a self-defeating, self-inflicted pain and a self-defeating proposition. In Spain, the same. The primary surplus that Spain would have to achieve in order to keep their debt ratios from worsening further from where they are today is plus 2%, whereas last year Spain had a negative, had a primary deficit of almost 2%. So the opposite of what is happening now. Now, it's clear that if they wanted to achieve that, they would have to, in order to cause more internal devaluation, then they would also see decreasing unit labor cost, more salary cuts, more unemployment, less consumer spending, less corporate investments. So it would lead into a vicious cycle, and so it's not hospitable. Finally, deflation is a problem for Germany itself. What we have seen in the last quarter is that the GDP of Germany has contracted. So it's not a rosy picture in Germany itself, and this is even before considering the potential negative consequences of the trade wars with Russia. The good side of the story is that we believe that the ECB will be forced into action from here, given the fact that the deflation is that bad for debt-laden countries like European countries, and we believe the ECB will be forced into stepping up their games from here. At the moment, they have stepped up their rhetoric already on a QE type policies, and we think that they will need to engage into non-conventional monetary policies from here on. We think that the result of that will be that not only deflation will push yields lower and spreads tighter, but also ECB policy themselves will be pushing in the same direction, pushing yields lower and spreads tighter. There will be two weapons firing in the same direction. I think that this is the main description of the story. I won't be able to go too much into the details of the specific trades to keep them confidential, but we think that in both optionality terms and through linear instruments, there is a great opportunity to be grabbed here in preparing for the ECB actions.